the investing mindset, and we're going to touch somewhat on cryptocurrencies as well.
So we've talked a little bit about this already in terms of money. And if you've been taught to save money,
How you can manage it.
yeah. But now you want to talk about some deeper strategies or some vehicles for investing.
Yeah, not necessarily deeper strategies, because that would get into the specific realm, and we are not financial advisors, nor are we licensed to be. So we're going to try to stick within the letter of the law, which is general subjects and general things that everybody can do and be aware of to make their money work for them.
Okay.
So let's start with the investing mindset.
All right.
So we've talked several times in the past about fear, and again, that's forthcoming episode specifically talking about fear. But this is pertinent in that a lot of people don't put their money into investments or investment vehicles to provide themselves with a greater income as they get older, especially after retirement, because they're afraid of making a mistake. They're afraid that they don't know enough. They're afraid of the fees that could be involved when it comes to hiring a financial planner. They're afraid of picking the wrong financial planner. They're afraid of getting in when the market is high and it goes down and they lose money. What do I do? You know, these kind of things. The investment mindset is this. If you pick whatever investment that you're interested in, and you feel over the next 20 years or more that that asset is going to be more valuable than what you're going to buy it for, then you should invest in it. Especially if you feel that over time it's going to provide you with an average return of about 5 to 7%. If it's greater than that, then fantastic. But if you feel that that asset is going to increase in value over 20 years or more, in some cases 15 years or more, especially for those in the older crowd. But if you feel that that asset is going to become more valuable than what you buy it for, then there's no wrong move to buy it.
You use that word asset, and you see crypto as an asset?
I see certain cryptos as assets. So let's be clear on that first and foremost. Cryptocurrencies are different than blockchain. Cryptocurrencies are a tokenization of a specific blockchain or layer. And what a blockchain is it's a ledger system to keep track of assets.
Which is, again, just computers that are recording transactions and keeping them in a safe way. All the computers have to be in agreement that this transaction occurred.
Correct. So cryptocurrencies are a tokenization of certain layers and certain types of blockchains, in the sense that money, cash, is a tokenization of the financial system and its poor health or great health in a given nation. Right? So the value of a dollar right now buys less than the value of the dollar back 3-4 years ago before COVID, right? Inflation happened and prices went up, and so you can't buy as much today with the dollar than you could 3-4 years ago. And so that is basically a tokenization of what can be purchased and not purchased at a specific level. And so that's what cryptocurrencies are. They're kind of a tokenization of whatever that system is. So there's multiple layers. So there's layer 2 and layer 3 blockchains that build on layer 1 blockchains. So for instance,
so in essence, are you saying any crypto could become an asset if enough people say that it has value? And that's really how anything goes. It doesn't have value unless people believe in it.
Well, that's true of anything.
Yeah.
in existence.
Mm-hmm.
If it has zero value, then nobody believes in it. Yeah.
Yes.
Okay. That doesn't necessarily make it an asset, because sooner or later certain ones are going to go to zero. There are cryptocurrencies out there that will go to zero, not unlike certain stocks that are out there that sooner or later are going to go to zero.
Mm-hmm.
That doesn't make them a feasible investment. Most people that invest in cryptos or stocks or bonds or whatever, most people that invest in those things, they guess that the value is going to go up. And some of those people that guess that want to become rich overnight.
Yeah. So
And that's the problem and that's why I said earlier, the investing mindset should be minimum 15 years out. 10 years out is really, really borderline for this kind of thing. So 15 to 20 years out, if you expect that asset to increase in value, then you should explore investing in it. It doesn't matter if it goes up and down in a day or a week or a month or a year or 5 years. As long as you can trend a line of it going up, then it doesn't matter what it did in between. The reason why people actually sell on dips is because they're afraid of things going to zero.
yeah. This also makes me think of the terminology pump and dump, which you see a lot of times with some of the fringe crypto. You have people that create that with the idea of getting rich quick.
Yeah, there's
And
also the term rug pull.
They advertise it as something that is going to be amazing, game changer. They get people on board because there's a lot of people that, again, they don't understand investment markets and things like that, but they do get the idea from a TikTok or some other
Or-
social
Or
media
a tweet.
that, oh my God, this could make me an instant millionaire. And they throw a lot of money into this, but it's nothing near where they really are able to make a change in their life necessarily, as opposed to feeding the system where the person that's really behind the levers here gets all it to a certain quick level, dumps it all, and creates a bunch of profit for themselves.
Well, one of the
and that's simplifying it, obviously.
specific to cryptocurrencies, similar things can be said about stocks, but stocks
Yeah,
don't really
yeah.
work this way. So with cryptocurrencies, if you do your research and you look at a specific cryptocurrency and what percentage of those tokens are being held back by the founders and the creators of the cryptocurrency, then you should be very suspicious on whether or not there's going to be a rug pull or whether or not there's a desire to improve something in the cryptocurrency world.
Mm-hmm.
And that's why I said, you could kind of say the same thing about stocks, but, for the most part, most stocks don't work that way. There are some overnight companies and pump and dump schemes, especially in the penny stocks and things like that. But for the most part, most cryptocurrencies are somewhat going to fall under there, and that's why I said earlier, a lot of cryptocurrencies sooner or later are going to go to zero.
Mm-hmm.
But the ones that have been around for a long time, the ones that are truly decentralized, the ones that where there's zero to very minimal amount of those tokens being held back by the founders and creators of the tokens, those are the ones that people are actually working on. Now, some of those are going to still fail, but at least you don't have to worry about whether or not there's going to be a rug pull or some kind of scam going on. Right? The ones that have scams going on are the ones that are saying, yeah, we're going to hold back 20% of these cryptos for our use and for the founders and the creators and things like that. Yeah, you should be pretty suspicious about those kind of things.
Sure. Absolutely. Good. Now, do you invest in any cryptos yourself?
Yes, I do.
Okay, great. And how long have you been doing that for?
I actually got in kind of late. I started in 2020.
How's it worked out for you so far?
I've tripled my net worth.
Nice.
And when I say my net worth, I don't mean just the crypto. I mean, my overall net worth has tripled.
So you'll keep investing in that.
Yes.
You have to monitor it closely, though. More
Yeah.
so than typical stocks.
You know, that's a great question, and it brings me back to the investment mindset.
Mm-hmm.
So, if you're not looking at your asset over what it might do over the next 15 to 20 years, then it's fairly likely that you're going to be looking at that asset on a daily and weekly and monthly basis. And that's where you're going to get some fear and or greed. So the asset's going up and climbing up and climbing up and climbing up, and it's like this parabolic rise in price, and you're afraid that you're going to miss out, so you buy in at a high price. And next thing you know, a month later, it dies, and then you want to sell, and guess what? You lost money.
Is there crypto that you invested in more than others?
Yes.
Probably Bitcoin.
I can't tell you that.
Okay. That's what I was aiming
And
at.
the reason why I can't tell you that is obviously I can't specify my investments, because that could be construed as me specifically asking our viewers to invest in these things. And I am not a financial advisor. I'm just trying to give as much general advice as I can give.
Some people would say that it's just a giant casino investing in crypto. And you're a gambler, right? You like to play poker.
You know, people say that about investing in crypto, but people have said that about stock market.
It can be said, for sure. And there can be risks associated with it.
There's risks associated with any investment. So
it's not to say you can't make money, though, right? If you do it, if you're well timed.
Let's use and we'll get back. I'm going to circle back to what you just said.
If you're well timed.
But let's talk about real estate. Real estate historically has been one of the most stable investments a person can make in their lifetime, and it's usually one of the largest investments that people make in their lives. But you know, the real estate market can bottom out. It has before. It will again. So there's always inherent risk in any investment that you can make.
Yeah.
It doesn't matter what that investment is. There's always going to be that. But if you do your research and you try to figure out where to best put your money, if you deep dive into that research and you are confident that this is a good investment for you, then you should invest in it. If you're not sure, or if you feel that fear is going to overtake you, then you should not, because you're going to make mistakes that maybe you can't afford. And so one of the best things to talk about at this point is whatever asset class that you decide to invest in, most of the time, if you're smart about it, it's not going to go to zero, but you have to be okay with that thought process. Otherwise, that fear is going to get into you, and next thing you know, you're making those mistakes I referred to before.
Sure. Yeah, so you wanted to talk about well-timed.
So, circling back to your comment about people wanting their investments to be well-timed, the more you try to time an investment as to when to buy in and when to sell and things like that, the more likely that you're going to be wrong and you're going to make a mistake.
So what's a good strategy then?
The best strategy is take whatever money that you can afford to put into that investment, whatever that may be, and every month put that in there. Whatever that asset or investment vehicle is there.
And then set it and forget it?
And that's what's called laddering, or average dollar cost averaging. So let's say that you buy in at $100, right?
Yeah.
And then you buy again at $120, the equal number of shares, right? Then your dollar cost average is 110.
Yes.
But then if it goes down to 90, right, and you buy an equal number of shares, now your dollar cost average is about 100, right? So no matter where the asset is at the time that you put the money in on a regular basis, it doesn't matter. In the long run, the value of that asset, as long as over 15 to 20 years you see this kind of pattern, as long as it's going up over time, it doesn't matter where it's at. So timing it is insane, because what you're going to do is you're going to try to say, okay, if it gets to $75, I'll buy in, and it gets to 78, and so you don't buy in, and it skyrockets back up to 110. And then you say, oh my God, it's going to skyrocket again. And then you buy in at 110, and then it starts dipping down to 90, and you're like, oh, maybe I need to sell it. It's really stressful, creates a lot of fear, which creates a lot of mistakes.
Depending on your age, though, I would think that you need to keep track of time in your investments, because the markets or investing can have some interesting cyclical patterns to it, right? And if it's the wrong time and you invest,
if the markets had a pattern, then everybody would be rich. There is no pattern. There is no cycle.
There's ups and downs.
There's a perception of those things, because people, by their very nature, want to see patterns in everything.
Yeah, they're always looking for patterns. But we know that it's going to go up, it's going to go down. It's going to go up, it's going to go down.
Yeah, when you think in terms of trying to figure out what the patterns or cycles are, you're still looking at short terms. You're never going to be right. I mean, look how many Wall Street experts that are out there that are never consistently right.
Mm-hmm.
And if these people are looking at things every day and at 50-year ranges and things like that, and they still get it wrong, what are the odds you're going to get it right?
That's a good point. I don't know.
Now, and you're also going to, hear these people on YouTube and elsewhere where, oh, I made this much for day trading, or I did this on Forex, and I did this, and I made this much. And what they don't tell you is how much money they lost.
Well, what is it that they're trying to do? Just build an audience like we're trying to do?
They're trying to build an audience, but at the same time, they want that perception of success so that you buy into whatever program that they're selling and things like that. And that's where they make their money. It has nothing to do with what they're investing in.
And you're not trying to do any of that here, even though you need 3 times your net worth.
I have no desire in talking people into investing anything in anything specific. It has nothing to do with me and what I want out of this. It has everything to do with what the viewers are looking for out of it, and just general concepts, which brings us to the different vehicles that they can invest in. So there's real assets like real estate, things like that you can invest in. That takes usually a decent chunk of money.
Are you vested in any real estate now?
I used to, and then I got out of the market. I'm looking right now. So investing in real estate.
Well, let's come back to that.
Investing in real estate it can be beneficial. It has pluses and minuses to it, depending on what your goals are.
Mm-hmm.
One is a major minus is that usually for you to not pay mortgage insurance, which can cost a decent chunk of money on a monthly basis, you have to come down with, depending on the bank and the loan that you're utilizing, you have to come down with at least 10 to 20% down payment, which removes a large chunk of money from other investments that you can be making, right? It's still a good vehicle to have, and there's benefit to having real estate as an investment vehicle. You just have to be aware of the pros and cons to it. The pro is it's a more stabilized investment, right? It's less risky unless you get into one of those scams where you're buying some swampland. So there's that. And then there's
Glenn Ross. Is that an example from that movie?
It's a good movie.
Yes.
And then there's investment vehicles like 401ks, IRAs, Roth IRAs, things like that. Some of those vehicles, so IRAs, simple IRAs, 401ks, things like that, are for pre-tax dollars, so they can help lower your tax bracket if you put enough into it. You have certain limitations depending on what your age is as to how much per year you can put in, and that money grows on pre-tax dollars. So what that means is when it's time for you to take distributions or take money out, if you do it at retirement age or older, then you'll get taxed at whatever tax bracket you're at that time of usage, and only for the money that you take out of there. Roth IRA has a smaller annual contribution
Cap.
allowance.
Yeah.
And the reason why is because it's a post-tax dollar thing. And what that means for you is when you put money into a Roth IRA, it's after you've already paid taxes on that money. But the fantastic thing about the Roth IRA is that as it grows, when you utilize that money, take distributions after retirement age, none of that money, no matter how much it's grown, is taxable. And so you kind of want to balance between the two types when you're using these two vehicles,
Sure.
so that you can lower your tax bracket by doing the pre-tax dollar ones, and at the same time put as much money as you can into the post-tax vehicle, the Roth IRA, so that you have an unlimited growth potential without having to worry about paying tax when it's time to use it.
Great information.
Be clear on what you're doing and why you're doing it. Have the information and the data. Do the research. If you're not willing to do the research, then you're better off with a financial advisor of one kind or another.
You have a lot of information for our viewers today. I feel like I can't just keep up with that, but keep encouraging you with questions, as if I'm a viewer myself.
Well, ask away. I'm here to answer questions.
That's wonderful. I appreciate that. And that's how it's going to be sometimes. I'm just going to ask the questions and you're going to give the answers.
Whatever your goals are, it depends on you to do the proper research to figure out what makes the most sense for what those goals are. If you're not doing that research, you can't expect other people to do it for you. And anybody that's going to give you financial advice without having those goals and the variables that exist in your life and where you live, if they're not taking those things into account, do not listen to them, because they're just spouting off what they're taught or what they truly believe in their own specific scenarios, in their own specific mindset. Has nothing to do with you. You have to be willing to do the research. You have to be willing to take the time and effort, because it's important to figure it out so that you know exactly what direction you need to head.
And if you want to learn more, call Scott at... No. Hey, just send us some comments. Let us know. You want more talk? You want some more conversations about these topics? We'll do it. Yeah, for sure.
Absolutely.
We'll take a deeper dive. We'll get some people on our hotline. Do we have a hotline?
Just please don't ask for specific recommendations, because I will not provide them, nor will we have guests that will do that.
No more advice. After October 26th, there will be no more advice.
Why October 26th?
Now, that's just from something Ringo Starr did. He is like, there will be no more autographs after October or something, or August, whatever. I don't know. I heard that on the Howard Stern show. Thought it was pretty funny. And so I brought that
I guess you have to be there.
To you today. You have to be there. We can pull it up and put it in the clips. For sure. Right on. Well,
anything else?
That's it. I think that's good. That's some good food for thought for people. So appreciate you tuning in, and we'll see you again next time. Bye.